The tragic attack on Ukraine by Russia was front and center this week. Tension in the area has been advancing quickly, and while there's much to consider from a humanities standpoint, our focus here is on the dimensions of the financial markets, including how we believe investors should approach uncertainty. We'll also discuss the three dimensions investors that strictly focus on short time horizons have to overcome, and why, in our view, investing across multiple time horizons, not just the short term, is important. No one knows just yet how this conflict will end. However, what we do know for sure is that financial markets dislike uncertainty. Thursday this week was a great example. Early in the morning, once news of the Russia attack broke out, stock markets were showing down 3 to 4%. That same day, the US stock market finished up 1.5%. That's a big change in just one day. Energy commodity prices have been rising in recent weeks with an additional price spike on the news of the attack. Russia is one of the top energy exporting countries in the world. Much of their economic success is tied to energy prices. Worldwide, we are feeling the impacts of higher crude oil prices. Now, rising oil prices started well before the Russian attack. However, the events of this past week have sent oil prices higher. Same is true for natural gas prices, specifically in Europe. European countries import a large amount of natural gas from Russia, putting many of these countries in a complicated position with respect to Russia. Now, if we follow the money here, we see that greater conflict leads to higher energy prices, which becomes a tailwind for the Russian economy. This week reminds us that the stock market is never certain in the short term. Also, how it's nearly impossible to predict and time stock market movements correctly and consistently. Think of the Thursday intraday price swings as an example again. When faced with high uncertainty and volatile stock markets, some investors may look to exit the stock market and get back in later on with the goal of missing the downside. Let's spend a moment on the challenge of market timing in the short term. In short, it's a three-dimensional issue that can lead to missing higher performing market days, which can greatly impact longer-term results. As a case study, this is a chart here that shows the difference between the stock market results over time and the market results had someone missed just the top 10 performing days. Over a 21-year span, the difference is quite substantial. What's important to acknowledge when attempting to time the market in the short term are the three dimensions of being right. Investors have to be right on when to sell or exit the market, when to buy back in, and importantly, right in terms of how much of an overall portfolio to act on. As an example, I could be 100% accurate with my timing out and back in, but if I only do it with 1% of my portfolio, it's unlikely to make any material difference. The takeaway here is that trying to be consistently right on all three dimensions is very challenging. Our view, we advocate diversifying portfolios across asset classes and time periods. We utilize 4 segments or buckets for planning and investing. These range from a short-term to a long-term segment. Now let's dissect a portfolio using these 4 segments and check in on the impacts of the recent stock market volatility. First, the short-term assured income segment. We set aside 3 years of income needs here in short-term, more stable investments. There's been very little movement here in recent weeks, which is what we'd expect. This is a segment that is reloaded or added to as stock markets are performing well and allowed to be drawn down on when stock markets are in decline, like we've been experiencing in recent weeks. Having 3 years set aside here provides time to allow other areas of the portfolio to recover. Now the long-term segment. This is where the volatility of the last 8 weeks resides. Investments in these segments are oftentimes higher expected growth investments that are down in price in recent weeks. The important aspect here is that these long-term dollars don't need to be touched for 10 plus years. When you see account values moving around, it's these long-term segments where the volatility is occurring, not in the short term. Oftentimes when uncertainty is high and prices are moving around more swiftly is when good new long-term opportunities arise. That could be in the form of new investments or even rebalancing between asset classes. In closing, here are several examples of prior market declines and the results in the following 12 months. Growth scares and market declines are going to occur as part of investing and accepting the uncertainty of being a stockholder in a company. What becomes evident is that market results, even through periods of uncertainty, have resulted in positive outcomes. 100% of the time, the market has recovered from declines and made new all-time highs. Now, we believe the key to long-term success in the market is having a plan and making sure that investments are aligned with the dimensions of your financial life.